Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by Chief Economist Don Rissmiller. Don, how are you doing this morning?
Very good, Russ. Good to talk with you.
Good to talk to you as well. I want to go through kind of three segments of the economy for which we have pretty recent data that should give an insight into where we start the year at. Let's start with the January jobs report, the non-farm payrolls report from last week. Pretty solid headline numbers. Unemployment rate ticks down. We add a bunch of jobs. What did you sense from that report? Was there anything under the surface that was important to look at? What was your overall takeaway?
Yeah, Ross, it was a good report. I mean, it's very hard to look at the numbers we got. The payroll survey was quite good. The household survey showed the unemployment rate declining, and say anything but that was a good report as we moved from December into January. Now, we did get revisions with that report for 2025, and those were to the downside, but that was older news. We knew those were coming. So the new news, the move from December into 2026, looks like we're starting out on a reasonably positive note. Now, there are always concerns about things like the birth-death model, and we have to look at how the response rate to the household survey has come down. So there can be some noise around this number. It will get revised. But even if it gets revised down to even half of where it was reported, that's still okay. Given the supply constraints on the U.S. economy, we're adding jobs. Even if we added jobs less than 100,000 a month, that's still probably an adequate pace. So there's room for revisions to that number to the downside, and still an ability to call it a good start to the year.
Yeah, we'll definitely take it after some of the jobs numbers from the back half of 2025. The other report we got, a CPI report, you had a note this week that kind of put inflation into a context that I thought was helpful, which is the upper income consumer relies on the stock market relies on the bond market, and for the bond market to be well behaved, it relies on inflation staying tame. The inflation report was good, at least for this month. But what else are you seeing from the broader inflation picture? And what does that mean for that kind of domino effect that you laid out?
That's right, Ross. So if we look at the inflation data that we got out of the recent report, again, we started out the year on an acceptable note. So there's been a tendency with prior CPI reports to see a January effect, meaning as you start the year, maybe you get some minimum wage hikes, maybe you get some companies raising price to start the year. And even though the data is seasonally adjusted, those seasonals may be imperfect. So January had tended to be a month where you saw more inflation come out of the CPI report, but we really didn't get a whole lot of that this year. It was a pretty moderate report for both the headline number and the core number. Now, there are still some issues with that data going back to October. So if you're looking at a year-on-year comparison, the shelter component still is going to be affected by the lack of data due to the government shutdown. That will be with us for a while longer. But again, I think we're taking the report as it's presented and saying it's okay. We're starting out the year in a perfectly acceptable fashion based on the CPI data. If there's a worry right now, it's more on geopolitics and oil prices. So if you start to see a spike there, maybe you get one-year inflation swaps moving, maybe you start to generate an inflation scare. And as you mentioned, there's a cascade. Inflation will affect the bond market will affect the stock market, and that will affect the upper income consumer that's been so essential at allowing the U.S. to continue to grow. So let's watch the commodity space. I think that'll be the near-term story.
Yeah, absolutely. And oil prices have made a pretty significant move this week already on some of those tensions. The last piece, a smaller portion of the economy, but the story of this year has been this rotation into real economy stocks, construction, machinery, industrials. We've seen some green shoots from some of the economic data out of that space, whether it's manufacturing, PMI, new orders, or industrial production this week, surprising a little bit to the upside. Are the green shoots there sustainable? And what do we need to see to continue kind of the manufacturing renaissance that has been long hoped for in the United States?
Russ, I think they're sustainable. It's been a long time since manufacturing has been a consistent contributor to growth We look at the ISM data, it's been close to 3 years since we've had that sector turn up. So I think we're just getting the very beginnings of an upcycle. What we'd like to see is the rise in something like the headline PMI confirmed with an improvement in the employment data and an employment in the inventories component. If we get all three of those, we probably have at least 2 years of runway in terms of an improvement in that sector. We could have up to 5 years based on history. So I think this is durable. There are a few other things we'd like to see to validate that. But going forward, the parts of the economy that have already had their recession, they've already been weak for 3 years, look like they're finally developing some momentum.
Yeah, a real positive to take a little bit off the shoulders of the U.S. consumer too, because they've carried the economy for quite some time now. So, Don, a really useful round trip through all the economic data. Thank you so much for the time, and we'll look forward to talking to you again soon.
Thanks a lot, Ross.